I'm Charlotte McLeod with investingnews.com, and here today with me is Adrian Day, president of Adrian Day Asset Management. Thank you so much for being here.
Well, it's good to be with you, Charlotte.
Good to be back with you once again, and not too long after our last conversation, just back in mid-November or so in New Orleans.
Right.
Yeah, so we're gonna pick up on some of the things we were talking about there, of course, and during that time, gold was having its comeback after the post-election correction. And I know you're feeling a little bit cautious, thinking maybe a longer correction for gold would be healthy. So how are you feeling about it now?
Well, we didn't get the longer correction.
Yeah.
And you know, it's a really interesting market. I think we're back, more or less, in terms of buying patterns. We're back more or less to where we were at the beginning of the year. The central banks are buying again. China, as we know, which has been the largest buyer, had been the largest buyer of gold for 2 years, but paused back in June. They're back in the market in November and December. So we're going to finish the year. We don't have the year-end numbers yet, but we're going to finish the year, if not at an all-time record high. It's going to be a strong... So the central banks have come in, have picked up buying. China has particularly come back into the market. And then North American investors have gone back into selling. So we talked about, I know how, you know, the North American buyers were just beginning to come back in, but now that's reversed as well. And so if you look at, for example, the GLD, which is a physical ETF, GLD since US Thanksgiving, not your Thanksgiving, but American Thanksgiving at the end of November, there's only been 4 days of inflows. Every other day has been an outflow. You look at the GDX, which are the senior stocks, the GDXJ, which are the so-called junior stocks, they're both getting outflows again. And significant, steady outflows. So we're back to where we were at the beginning of the year. And, you know, the central banks are buying, China's buying, wealthy Middle Eastern and Asian people are buying, but North American are still selling. And I think that's a reflection, to preempt your question, I think that's a reflection. We know why the central banks are buying, because, and this is a point I would make, I think gold is going to continue to go up. And certainly even in November, I was thinking of a shorter-term correction. I wasn't thinking, or what I said is it would have been healthy. But the reason central banks have been buying for the last 2 years haven't gone away with Mr. Trump. And if anything, with Trump threatening 100% tariffs on any country that dares move away from the dollar, that does not make South Africa and Brazil say, sorry, we didn't really mean it. It makes them want to step up their defenses against dollar weaponization. So, you know, I think that source of buying is going to continue to be very strong. And the second largest source of buying is the Chinese retail and consumers, and they're buying because they're worried about the economy, they're worried about the yuan, they're worried about real estate, record number of house foreclosures in December in China. And they don't want to put their money in a bank because the banking system is a little bit fragile, so gold is going to be a beneficiary there. So I think those trends are going to continue. The real question is, when does the North American and European, but the Western investor, particularly the North American investor, turn from selling back to buying? That's the real question.
That is the real question. And do you have an answer? Yes, I will ask it, please.
We have to look at why are North Americans not buying? I think that's an important thing. They're not buying because the economy is supposedly strong. You know, the jobs, if you want, we can talk about that, but last week, $256,000. Okay, the jobs market's strong, the economy's strong, retail sales strong. Inflation, wow, way down from over the last year, so inflation's under control. Stock market's strong, both in Canada and in the US, and the dollar's strong, US dollar's strong. So all of the factors that would make people want to buy gold, I mean, none of the factors that would make people want to buy gold are actually present, apparently. So I think it's going to change when the economy starts, when it's obvious that the economy is slowing, when the stock market, it's obvious that the stock market is rolling over, And if anyone's looked at a chart of Apple for the last 2 months, they might think it's already rolling over. But Apple, Microsoft, even NVIDIA had a pretty good correction. But the first two are sort of rolling over. And when you think that 5 stocks, that's 3 that I just named plus 2 others, when you think the 5 stocks have been driving this market for the last 2 years and represent 16% of total world equity markets, for the decline in those markets, in just those handful of stocks, it becomes very significant. So I think when the stock market is rolling over, then people start to say, okay, where do I want to put my money? And of course, there's lots of places to put it. There's value stocks that haven't moved, but have lagged, the growth stocks. There's income-oriented and defensive stocks that have lagged the tech stocks. There's foreign markets that have lagged. There's oil stocks. But there's also gold stocks.
That's right. And I think listening to you talk there, maybe apparently doing well, apparently is the key word there. And I do think we should talk about the jobs numbers out of the U.S. that we just got. Because you were so clear when we last spoke that, under the surface, the labor market is not as healthy as it appears. So what were your thoughts there?
Well, yeah, the 256,000 jobs that the BLS reported, new jobs, was much more than people had expected and more than the previous few months. Again, when you look under the hood, you see low labor participation rate. It hasn't moved much, but 2/3 of people in the working age group are actually in the job market. So that's a low labor participation rate. You look at the number of hours worked, the average, not the average of the new jobs, but the average is 34 hours. So meaningfully below a 40-hour week, and that's the average. But I think 2 other things are perhaps more significant. One is the BLS reported on Friday 256,000 new jobs, of which they said 223, I think, were private sector jobs. The ADP, which is a private organization which reports only on private sector jobs from payrolls, and they reported the day before, they reported 120,000. So one of them is wrong, right? The BLS is almost double what the ADP says, so one of them is wrong. That's the first sort of bit of caution. And the second bit of caution is we know that the BLS numbers are subject to significant revisions. They always have a first and a second revision. I'll be willing to bet anyone today that those revisions will be downwards. And if you look at the last, since 2022, so that's 3 years now, probably 3/4 of the months have been downward revisions, and increasingly so in the last year or two. That's apart from the massive 818,000 that the BLS one day said, we seem to have overcounted the number of jobs created last year by 818,000. That's a separate one-off, but every month they revise numbers. And last year, probably 9 months were revised downwards. So those numbers have become, I think the BLS numbers have become increasingly unreliable, frankly.
Yeah, it kind of sounds like if they are constantly revised and often revised down, why are we even looking at the first iteration?
It's the same with all of these things. It's always that first release that gets the market excited, and the second, they have a first update and a first revision, a second revision. The second revision hardly gets any notice, but that's the more accurate number. No, they've become so, I don't know, I mean, some people think it's a conspiracy to help get the Democrats reelected. Didn't work. Some people think it's incompetence. And it may be both of those two things, but it may also be that it's just too complex to get the numbers right.
All right.
But whatever the reason, the numbers are increasingly unreliable.
Okay, so we've got your take on that jobs numbers from December. Also want to talk about CPI. We just got this data this past Friday, I believe, and market participants seem excited by that core CPI number, and I'm sure you've got thoughts on that, whether it's warranted and what the broader picture really is here.
Right. Well, any 1 month, whether it's jobs or CPI, any 1 month can be, 1 month doesn't make a trend. And I mean, Jerome Powell at the Fed says the same thing. They want multiple months. I mean, if you look at the last 5 months, there's no question, well, at the very minimum, you can say inflation is not continuing to go down, but the trend is definitely upwards. The trend is definitely upwards. And I think, I think we're going to continue to see that. It's interesting to me that the Jerome Powell and many of the other Fed spokesmen have started talking about a new measure. Everybody talks about the CPI. That's what we all talk about, the CPI. And then they started talking about CPI core, for people who don't eat or drive or heat their homes, to make the numbers sort of look better because apparently food and energy are so volatile that we shouldn't look at them. Well, maybe on a month-to-month basis they're not important, but they're still a significant part of people's cost of living. So then the Fed went over to the PCE, personal consumption expenditure. Then they went to the core PCE, and they're really trying to find something that will get the numbers where they want. So now they're talking about market-based core PCE, which means they exclude, as you probably know in these inflation indexes, some things are just, the price of oranges at the store, and some things are imputed. So rent is imputed from, what do they call it? Sorry, rent owners, forgot what it's called, but it's imputed. It's not an actual number, an actual statistic. And so now they've got this market base which excludes all of the things that are imputed. Well, eventually you're going to wind up with one thing somewhere which is going down and say, we finally found the index we like. Because all those things, whether it's rent or food or energy, they're the biggest part of anyone's budget. And so that's what inflation is. That's what the cost of living is. And I think we're only going to see it continue to go up. I mean, again, inflation is a monetary phenomenon, and we shouldn't forget that. I mean, the most fundamental thing about inflation is it is a monetary phenomenon. So if you print excess money, then either you have an increase in the goods and services, or your aggregate prices move up if you print excess money. And that's why prices have been going up. That's why the stock market has been going up. That's why crypto has been going up. There's just excess money around, and then money has to find a place.
Okay. So here we have the Fed seeking its one true inflation measure in 2025, I guess. What can we say about Fed rate cuts or actions this year, especially because they've said we're going to be data dependent?
Right. Well, I think the market is now overly pessimistic and thinking there's only going to be one rate cut this year. And I think it's only one next year, isn't it? I'm not sure. But certainly they've cut back on the expectations. Just as, I don't know if we said in November, but certainly back in September, I said the market was overly optimistic about the number of expected rate cuts. But I think right now, saying only one rate cut this year is overly pessimistic. It seems to me fairly clear that Powell and the Fed is fully aware, they're fully aware that inflation is not where they want it. Right? They've said that. Inflation is not where they want it. Their target is 2%, and as we've discussed before, 2% is a totally arbitrary target. If you want stable prices, it should be 0, not 2%. But they know full well that they're above 2%, whether it's 30, 40, 50% above 2%. And they also know that the move from where we are now down to 2 is difficult. So they're aware of that. They're also aware that there are indications in the economy that are not positive, particularly for people at the lower half. We talked last time about credit card defaults. Well, now you've got credit card write-off, where the banks just are writing off the debt, and those are now moved up to record highs. So that's not evidence to me of a very strong economy for that meaningfully large portion of the population, whether it's 30% or 50% of the population. It is basically living from paycheck to paycheck. So the Fed is aware of that, but at the same time, they know they have to move, on the one hand, they have to move rates down to help the economy. On the other hand, they can't move too fast or risk inflation moving up. And you've got the other important factor, which is the government debt. Um, the incoming administration is going to have a bit of a struggle for the next several months, frankly, in selling the treasuries without interest rates moving up, because they've depleted the repo fund, which was built up and used as a way of buying treasuries. Yellen depleted that completely. And there's a big issuance coming in the next 3 months, with T-bills previous issuers rolling over. So I think rates are going to certainly at the long end, rates are going to move up because the demand for long-term treasuries simply isn't there. It's not there from the traditional buyers. It's not there from China. It's not there from Japan. It's not there from U.S. banks. And it's not there from the Federal Reserve, that used to be the biggest buyer.
Okay, so Trump has come up a couple of times already in this conversation. So we're sitting here, I think the inauguration has now happened or may currently be happening. Anything else that we can say right now about the impact he may have on the economy?
I mean, that's a question we have to ask, and it's a huge question.
Very big.
And of course, there's a lot of unknowns at the moment. I would like to be optimistic because obviously, nobody's wishing the U.S. to go into depression or anything. I think there are some signs, there are some reasons to be optimistic. I think the most important reason to be optimistic is if the Trump administration can cut a lot of the duplicative, meaningless, regulations that have been put on small business. That is something that can be done easily, and it will have a very, very immediate response. I don't think people realize just how much time a small business spends on regulation, whether it's a bakery dealing with the health department and your sink is 3 feet from your counter where it should be, it's 2 feet and 11 inches, but it should be 3 feet. Or in my business, finance or doctors or whatever. Meaningless, duplicative, illogical regulations that really hamper new business creation and really hamper small business getting going. And so cutting those regulations can have a very, very significant and near-term impact. So that one I'm very, very hopeful on. And if they follow through on that, the economy could continue quite strong. The cutting of the government budget, as everybody says, it's just a difficult job, and at the minimum, it's going to take time. If you lay off federal workers, you still have to pay them severance pay for the next 12 months, most of them. And so you're not cutting the spending. We know there's an awful lot of waste and duplication, as well as just stupid spending. But every congressman wants the spending. He has his own pet project, and he wants the spending in his own district. So I say to you, support my stupid spending, and I'll support your stupid spending. And that's the way it goes. They don't say, well, I'll cancel yours if you cancel mine. And so it's going to, and so much of his spending will have to go through Congress. And that's difficult. There's no question that there's a huge amount. I mean, there's fraud in Medicare and Social Security. So there's some fraud. They could step up investigation of fraud. But there's waste and inefficiency. That's the biggest part. You can cut out the sort of $150,000 grant to the lesbian theater collective in New Hampshire or something, but that doesn't save you much. We should certainly get rid of all that stuff. But the waste and duplication is one of the biggest things they can tackle. And, that's not easy because it means going into the organizations and, basically controlling it. A lot of it has to go through Congress and be approved. There's no question the waste is there. And then, of course, the big ones, the elephants in the room, are Social Security and Medicare. They've said they don't want to touch Social Security. At some point, someone in the U.S. has to be brave enough to say we need to tackle Social Security. If you think when Social Security came in 1940, was it 45 or 47? 47, I think. I'm not American, so I don't know all this stuff. When Social Security came in 1947, the life expectancy was lower than the age of retirement. So Social Security, the way it was set up, was they never dreamt they would be supporting people for 10 or 15 years. And we could have solved that problem, or they could have solved that problem, just in 1953, 1956, say, every couple of years we're going to increase the date that you start getting Social Security based on life expectancy. Now it's become much more difficult. How do you say to somebody now, well, you know what? You've got to increase the Social Security by 50%. And, we said we'd give it to you when you're 69 and a half, but now you're not going to get it till you're 79 and a half. I mean, that's much more difficult. Raising it by half a year every couple of years would have made the program solvent, and nobody would have complained. And, nobody had the will to do it, unfortunately. And the longer you push these things down the road, the more difficult they get. But someone's got to tackle that at some point. I mean, we talk about the U.S. budget, the national debt being 36 trillion or whatever, and everybody's aghast. But the real number, if you count all of the unfunded liabilities, which is the way you and I would do our household budget net worth and the way a company would look at it, you've got liabilities that you have to pay in the future. If you include all those liabilities, Social Security, Medicare, Medicaid, the national debt in the U.S., there's estimates anywhere from 150 to 200 trillion. So a multiple of the 36 trillion. In some ways I think it's too late, frankly, to do it in any rational manner. But I wish Trump and Vivek Ramaswamy and Elon Musk, I wish them well, but little bit skeptical.
Yeah. What a mess to clean up when you lay it out all like that.
Yeah.
So yeah, and I think that is the general theme I'm hearing here is, cautious optimism, but, we're not sure how this is going to play out. Okay, so we've got to look at some of the things that are going on in the background here. We talked a little bit about where the gold price is going. I want to bring it back to you because we're here at DRIC, and I know you're on a panel coming up called Gold. The price is up. Why aren't stocks moving? And I hope to go see it this afternoon is when I think it is. But I think it's a question on many investors' minds. So can we get a preview of that?
Yeah. Well, first of all, let's say that the XAU, which is the U.S. index, from the beginning of last year is up 19%. So let's not cry too much. It's up 19%. That's not so bad. Everyone's complaining because it's not up as much as they would like, and their stock isn't up, right? I think there's two reasons for it. We go back to why gold moved over the last 2 years, who was buying and why they were buying. Well, the People's Bank of China is not going to buy Newmont for their reserves, let alone are they going to buy Ajax Exploration. They're trying to move away from the dollar, and they're just not going to buy gold stocks for their reserves. The same goes for Chinese consumers, who are the number two source of buying. The same goes for the wealthy families in the Middle East. You want to protect your assets. Protection means physical gold. It does not mean Newmont or Ajax. And so the reason that gold has moved over the last 2 years and the people buying and their reasons for buying really explain 90% of the reason, in my view. And then we come to where we are right now. I am surprised that there's ongoing outflows. There's no question about that. I am very surprised that there are outflows in gold and gold stocks at the moment in North America. But the reason that we don't have massive inflows is perhaps a little easier to comprehend, and that is that the economy seems strong, and Trump's going to make it even better. and inflation is under control, and Trump's not going to do anything bad there, and the dollar's strong, and Trump's going to make the dollar even stronger, and the stock market's doing well, and Trump's going to make the stock market even stronger. Why do we need gold? And so the narrative is just not, at the moment, is just not favorable to gold investing. That'll change, and I think it'll change when, well, we talked about that, when the stock market rolls over, and when it's obvious that the economy is slowing.
Okay, yeah, I think we kind of came full circle there, so everything joins up together. The other thing I've been hearing about the gold stocks at this event is that, if your stock isn't moving, the better ones are. So is it a case of we need to be more selective, and that's how we need to act moving forward if we weren't?
That is certainly true with the juniors. I mean, at the beginning of a gold bull market, money, and we've talked about this before, but everybody knows at the beginning of a bull market, most of the new money flows to the big cap miners. And then later on, and the big cap royalty companies, and later on it flows to the intermediates, and then the juniors, and finally the exploration companies come in when, in the, I was going to use a baseball analogy, but I don't understand baseball. So in cricket terms, when your eighth batsman comes out to crease, the juniors start moving. There's no question at the moment, but if you look at both the seniors and the juniors, frankly, the better quality companies are definitely performing better, and the market is being very, very quick to punish companies that have problems, whether it's Franco-Nevada and their Cobre Panama royalty, or Mali with Barrick. But the market is punishing those companies' stocks very quickly, but it's also rewarding very significantly companies that have good returns. So I think the junior or good exploration results or anything, so you look at a company like Origin, which has a royalty on silicon, the stock's done very well. You look at AMARC that had good results last week, the stock's jumped. So the market, people are paying attention, but I think it's obviously the same group of investors. So when they buy one thing because it's doing well, they're selling something else. The time when, the broad junior sector, that is good companies with good people doing good work, but nothing dramatic happening, the time when those stocks move is several years away, I think. So yeah, we have to be a lot more selective.
Yeah, and a lot more patient. I think you're always good at reminding us how long things take to really play out. That's right.
No, absolutely. And that's true of the juniors and the seniors.
Yeah.
Yeah, you really have to be patient. But again, as painting with broad strokes, we've talked about this before, the gold stocks are extraordinarily undervalued right now. You look at Agnico, which is now the second largest gold mining company, and I pick Agnico because nobody can point to Agnico and say, oh, that's why it's cheap. You point to Barrick and they say, oh, it's cheap because of Mali and Pakistan. There's no reason why Agnico is undervalued. It's going to end the year, we think, estimates, fourth quarter hasn't been announced yet, but it's going to end the year at a price to cash flow under 10, which puts it in the lowest decile of its entire history. Now, typically, when the gold price moves up, the margins expand. So you're in a situation where you've got a high gold price, you've got expanding margins because the price of oil and the commodity currencies, I don't need to talk about the Canadian dollar, but the same is true of the Australian dollar. The Australian dollars are 68 cents, 67 cents or something. 15 years ago, it was trading at a premium to the US dollar. So the cost inputs for the miners, both to run a mine and to build a mine, although some of them are moving up, not the Canadian dollar, but the price of oil, some of them are moving up, but the costs are not moving up as much as the price of gold. So the margins are expanding, the stocks are cheap, they're under-owned. I think the setup is just perfect for gold stocks, but you just have to be patient.
Okay, which is hard to do, but I think that's a nice place to wrap up, is on perfect setup, unless you had any last words.
But perfect setup's a good place to start.
Okay, we'll end it there. Thank you so much. Really good to have you as always. And once again, I'm Charlotte McLeod with investingnews.com, and this is Adrian Day.
Thank you very much.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.